India's financial markets are watching capital leave at a rapid pace. Foreign institutional investors and portfolio managers are rapidly liquidating their domestic assets. This chart plots those capital outflows over the last few years. You can see roughly $45 billion worth of Indian assets sold off in 2024. The next year, foreign portfolio investors dumped another $18.9 billion. And in just the first 4 months of 2026, the sell-off has already crossed $20 billion, eclipsing all of 2025. When this volume of capital exits the country, the domestic supply of US dollars shrinks. As dollars become scarce, it takes more rupees to buy a single dollar, driving down the value of the Indian currency. To stabilize the exchange rate and stop the rupee slide, the domestic market requires a massive, immediate injection of foreign dollars. The responsibility to engineer that dollar injection falls to the Reserve Bank of India. Their strategy was released quietly last week through 2 highly technical policy notifications. The operative phrase in both documents is US dollar rupee Forex swap facility. These policies target 2 specific channels: overseas corporate loans, known as external commercial borrowings, and fresh foreign currency deposits from non-resident Indians, classified as FCNR accounts. Policymakers project that tweaking the mechanics of these specific accounts will attract up to $50 billion in foreign capital. For a non-resident Indian, a standard U.S. savings account pays around 4 to 5% interest. Indian banks are currently offering a much higher 7% return if those dollars are deposited in India. The main reason investors hesitate to move their money is currency risk. If the rupee weakens against the dollar during the deposit, the exchange rate loss can wipe out the extra interest earned. The RBI swap facility eliminates this exact problem. When an investor deposits dollars into an Indian bank, the bank hands the dollars to the RBI, receiving rupees in exchange. 3 to 5 years later, the RBI returns the dollars to the Indian bank at the exact same exchange rate, completely ignoring any drop in the rupee's value. By absorbing the exchange rate fluctuations, the central bank separates the investor's interest payout from the volatility of the Indian currency, creating a highly insulated trade. Normally, banks have to pay a 3.5% annual hedging cost to insure against currency drops. For these new deposits, the RBI is absorbing that cost entirely, making the protection free. The RBI is also exempting these specific funds from standard reserve rules. Usually, banks must lock away a portion of all incoming deposits in cash reserves and statutory liquidity ratios. To see how this impacts the bank, look at this breakdown of a standard deposit. If a bank takes in 100 rupees, locks 20 in reserves, and lends the remaining 80 at 10%, they earn 8 rupees in interest. After paying the depositor 7%, the bank keeps a net profit of 1 rupee. Without reserve requirements, the bank lends the entire 100 rupees, earns 10 in interest, pays the depositor 7, and pockets a 3 rupee spread. Tripling the profit margin on every deposit gives domestic banks the financial flexibility to offer non-resident Indians higher interest rates to bring their money over. But moving capital across the globe for a minor bump in yield is rarely worth the hassle for most investors. The actual draw is a mechanism called a letter of credit. It acts as a guarantee from the Indian bank, allowing the investor to take out a separate loan secured against their initial deposit. An investor can use this letter of credit to borrow from a U.S. bank at roughly 4.5% and immediately deposit those borrowed funds back into the Indian bank to earn 7%. By looping the money and borrowing heavily against the initial deposit, the investor is earning the interest rate spread on a much larger pool of capital. This structured leverage is the core incentive. It scales the baseline interest rate into a highly aggressive effective return, estimated between 15 and 26%. Scaling this leverage strategy across thousands of high net worth accounts is how policymakers plan to secure that $50 billion target and rebuild the nation's foreign exchange reserves. This exact financial machinery was deployed successfully during the 2013 global market panic, known as the taper tantrum. Former RBI Governor Raghu Ram Rajan used a nearly identical swap window to pull in $34 billion and reverse a sharp drop in the rupee. However, the macroeconomic environment is vastly different today. In 2013, U.S. Treasury yields were close to 1%. Now they are hovering around 4.5%. Because capital can earn competitive yields domestically in the U.S., the current Indian administration is forced to offer zero hedging costs and aggressive reserve exemptions to attract the same level of interest. Early estimates suggest up to 30% of the incoming deposits might simply be investors closing out existing accounts to take advantage of the newly subsidized rates, meaning billions of these dollars are not actually new capital. By guaranteeing the exchange rate for every incoming dollar, the central bank is absorbing the nation's currency risk onto its balance sheet. We are watching an intricate display of financial engineering. The coming months will determine whether these technical maneuvers can successfully secure the currency, or if taking on billions in exchange rate risk proves too costly a burden.